The dynamic bond fund and the Gilt fund are active duration products where there is no maturity constraint either on the upside or on the downside. As we have discussed many times before, we think India government bonds and India bonds more widely are probably a structural story because they are experiencing a confluence of medium and short term factors which are bullish. Both these products are 99% plus exposed to long tenure government bonds which are 2053 maturing government bonds. The rationale for this is basically as under. Given our view on the market, we wanted to run maximum duration in these products because we expect the India bond story is now going to play meaningfully over the next few years. We want to build duration primarily via the government bond market because we assess the demand supply environment is the best in that market. The selection of long tenure is also basis what long tenure government bonds are actually the so called FAR government bonds or the free access route government bonds. Now 2053 is one such government bond which is not just long duration but also enabled for free access route from FPI investors, which means that FPI investors can come and go from this bond as they please without limit restrictions. So that's also one reason why we have chosen to be exposed to the 2053 bond. Now one of the concerns investors may have is about liquidity in the long tenure government bond segment. In our view, that is not a concern anymore because unlike 5 or 10 years back, now the single largest incremental investor in the market is the long term investor, which is the insurance pension sector. 37% of new government bond supply over the course of 1 year is now in 30, 40, 50 year segment. So this segment is no longer as exotic or as illiquid as it used to be in the past, and we remain reasonably comfortable about liquidity in this segment as well. The other concern that investors may project is that as RBI cuts rate, yield curve will steepen, and therefore is not a 5 or 10 or 15 year exposure better suited? Our answer is no, for two reasons. One is we think India bonds is as much a rate cut story as it is an asset discovery story, and we do not think there will be too much steepening of the yield curve as the RBI cuts rates. Second, mathematically the 30 year or the 29 year government bond offers a modified duration of roughly 12, which is higher than what the 10 year 12 year segment offers, if not more, and therefore as yields fall, even if there is some widening of the yield curve, some steepening of the yield curve, the actual gains made in rupees terms may actually be similar or higher for the long duration government bond paper. So that in sum is the strategy for both these products.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.